This is TreppWire Week in Review for week ending May 27th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, Fed meeting minutes show half-point rate hikes are likely in the next couple of meetings, and a rush of retail earnings give us a picture of consumers shifting their spending habits. Durable goods orders grew at a slower pace, and sales of new single-family homes dropped sharply last month. Manus, equity investors have had it rough lately, but the outlook for stocks improved today after investors digested this week's news.
They certainly did. It was a bit of a surprise, I would say. The Fed came out on Wednesday with the minutes. The minutes were more hawkish than people would have thought. There was real consensus around the fact that the Fed would be raising interest rates for the rest of the year. But when the Fed came out and said multiple near-term 50 basis point rate hikes, that's the kind of language that I would have thought would have triggered a new round of selling. The reaction is not what you would have thought. The markets were up after the 2 p.m. announcement on Wednesday. They really surged on Thursday. And last week, sometimes there's this expression used that the market lacks conviction. And what that normally means is there are some run-ups, but they're short-term bounces and they don't seem to be enduring, and they fade away very quickly. And that wasn't the case last week. There was enormous conviction, and there was enormous conviction that the end was near, right? That the S&P had another 25% down to go. We were going to see S&P 3000 or S&P 3200. And the sentiment was incredibly negative. And then the Fed minutes come out, and surprisingly, investors turn bullish. Hard to explain. And what we're seeing in the news and we're hearing from traders these days is investors never wait until inflation gets back to 2% to jump into the market. They jump in the minute they think we've reached an inflection point. And what the consensus seems to be now is the Fed is going to win the inflation fight. They're going to hammer us for the next 3 months with high interest rate hikes. We're going to endure some pain, and then we're going to see a big rally over the second half of the year. And investors said, well, if that's what we're going to have to do, we're not going to wait to get ahead of this rally. We're going to jump in now so that we don't miss the easy money to be made. Do I believe in that? I'm not really sure. I think we have more legs to go down. I think this inflation is going to bite. It's going to hurt lower income people. It's going to lead to lower spending. But for right now, as of Wednesday, Thursday, going into Memorial Day, people are bullish, right? People think they see a light at the end of the tunnel.
Yeah, it's funny as you talk through this, Manus. If I was looking at 20-year-old Lonnie, I don't think I would get jazzed reading about Fed minutes being released. But it is interesting how we kind of get excited to see what the tenor is. And it's really interesting. I saw a couple of photos on Twitter this week. Gas prices in California up over $7 a gallon now, like $7.60 a gallon. So I don't know how you can be bullish when gas is costing people $7 a gallon. Even here in Texas, it's up over $4.50 a gallon. So, the Fed's walking a fine line. They're trying to tamp down the inflation, but not, bring down the financial stability with the Treasury or commodity markets. A couple of other bullet points here, some potentially good news. Orders placed with U.S. factories for durable goods rose in April. This was highlighting firm and sustained demand for equipment and merchandise. They were up 0.4% last month. That was on the heels of being up 0.6% in March. So sixth increase in the last 7 months. So total durable good orders are up 9.7% from a year ago. Some bad news, though. Another headline this week, sales of single-family homes fell really sharply. I think this is a pretty good indicator of potential recession hanging out there. So some numbers on that. Sales were down for the fourth straight month, dragged down by a combination of high prices and rising mortgage rates. They declined 16.6% month over month. Estimates had come in expecting a 1.7% decline. This month over month slide was the biggest since 2013, and the rate of sales was the lowest in the last 2 years. So interesting, Robert Dietz, the chief economist for National Association of Home Builders, called the plunge a clear recession warning for the overall economy for the quarters ahead. So it's very interesting. You say maybe the markets reacted positively, but if you look at some of these larger macro items like home sales, there's some storm clouds brewing, I would say.
Yeah, I mean, there's two different things going on here, and there always is, right? Thing number one, like the Dr. Seuss thing one and thing two, right? As they have in the old books. I feel like I'm talking like a second grade reading teacher right now. But thing one is the stock market, and thing two is the real economy. And traditionally, the stock market will front run bad news and it will front run good news, right? We started to see the markets wobble, not when we got to peak inflation, and who knows if we're at peak inflation yet. We may be, we may not be. But, the market started to wobble when people started to say 4% is going to become 6%, is going to become 8%, is going to become 10% PPI, right? And where the stock market changes, right, is when people say, all right, we have reached this peak and 10 PPI is going to become 8 and 6 and 4, and they try to front run that. And that contributes to the wealth effect. And when people feel good about their portfolio, generally speaking, consumer sentiment improves, people take vacations and so forth. But to your point, Lonnie, thing two, to go back to Dr. Seuss, is the real economy. And the real economy, even if the stock market is up 1 or 2% today and tomorrow and next week and so forth, that doesn't help the guy who's spending $100 filling his tank. And it does lead to behavioral changes in consumers, pain at the consumer level. And there are some winners that come out of this. We'll talk about this a little bit more during the retail earnings part, and there will be some losers. So, two different aspects of the economy, and it's important that listeners kind of understand the difference. The stock market is not the same as the guy who's running a deli in New Jersey trying to make ends meet.
Interesting, Manus. I saw that our revised GDP numbers for Q1 were brought down from the original report. And yet, conversely, the Congressional Budget Office gave us estimates that were upbeat for the rest of this year.
They did. They raised their GDP expectation, and they also said inflation will fall back to 2% in 2024. And I think headlines like that contribute to traders trying to get ahead of the curve in terms of putting money to work before inflation gets back to 2%, right? Kind of timing this inflection point. But I do think, the CBO is meant to be nonpartisan, independent, putting out numbers that they believe are accurate. And I think most government workers do. But, the Fed themselves and our political leaders and so forth are towing a difficult line, or, walking a tightrope, so to speak, in that they want to get inflation under control. They have to feed us castor oil, so to speak, with higher rates, but they don't want to make it sound like we're going to be taking castor oil for the next 6 months and rattling everybody. So they have to balance kind of the bad news with the good news, in an effort to prevent markets from dislocating, credit events from happening, people from panicking and so forth. So, some of that is always part of their job.
So let's dig into the earnings. We had a lot of earnings to digest, and it was a mixed bag.
It was quite a mixed bag, but the funny thing was, it was all crabgrass for the 10 days prior to Wednesday and Thursday. And then Wednesday and Thursday, we started to see some green shoots. So we talked about this last week, first Target and then Walmart really spooking people with lowering forecasts, talking about inflation, supply chain issues. That contributed enormously to last week's sell-off, right? When Target announced, people thought maybe this is a one-off. When Walmart followed up with the same message that Target had the previous day, it went from being a blip to a trend, and the markets really sold off sharply. And then we saw several other companies follow suit in the ensuing few days, right? Kohl's came down that path, right? Lowering forecast. Best Buy, same story. Dick's Sporting Goods, talking about challenging macroeconomic conditions And all of these guys were kind of in the same boat. In most cases, better than expected revenue, better than expected or equal to expected earnings, bottom line numbers, but troubling future forecasts. And that was the narrative earlier in the week. And then Tuesday, Wednesday, Thursday, we started to see that turn. Nordstrom on Tuesday, first quarter sales that beat expectations. They raised their forecasts. Macy's today, I think their shares were up almost 20% as they reported better than expected quarterly results. Williams-Sonoma, the home furnishing seller, up 15% today. And then on the lower end of the market, Dollar Tree and Dollar General, both up about 15 or 20% today. Same type of story, higher earnings, strong forecast. So if you would ask me on Tuesday afternoon before the Nordstrom numbers after the bell, I would have said, man, there's just a hell of a lot of pain out there. And now Thursday, after, these last 72 hours of announcements, it's a different story. It's a much more muddied picture.
Yeah, I would wonder if this can be sustained, though, especially if you look at like Nordstrom and Macy's. I think they attribute some of their, earnings and positive outlook to buyers and consumers refreshing their closet. And Macy's, it was, saying that it's shop for new outfits, luggage, and luxury goods. I don't know, folks that have been home for the last 2 years, working from home, maybe going back to the office or getting back to conferences or having to buy a size or two larger clothes than they had before. I don't know if that's sustainable, though. These retailers had some challenges leading up to the pandemic. Ralph Lauren was interesting, stronger than expected earnings. And I think Costco revenues beat estimates as well. So there were some viral tweets this week about Costco raising the price of their hot dog. So I don't know if you guys are familiar with that story, but basically they've kept the price of the hot dog, I think, at $1.50. And there's kind of a legend about the CEO saying that they'll never raise the price. And I think it finally broke that they're going to have to increase the price. So inflation has finally gotten to the Costco hot dog. One last thing here, Jan Niffen, retail analyst on CNBC, who was actually a guest on the podcast about 2 years ago, today said there's a bifurcation in retail with goods that support travel and experiences being in demand and consumables being more price sensitive. Looks quite possible challenges of Target and Walmart stemmed from a failure to anticipate the consumer's change in preference and react accordingly, rather than from a reluctance from shoppers to spend dollars. So just some additional insight there maybe into how that market's been bifurcated.
So I'll throw one more earning out there that we saw just minutes ago. This was the Gap, which came out after hours on Thursday. Their shares were down 15% after they reported a decline in sales. They were hit primarily with a downturn in sales at Old Navy, and their CEO came out and said that their low-income customer, which is the kind that would be going to Old Navy, is really getting pinched by inflation. So if we weren't muddied before 4 o'clock today, we got even muddier after 4 o'clock. But normally when you see these things coming out, right, numbers, I find at least, you can bucket them into categories, right? During COVID, you could say, in the beginning of COVID, grocery stores by and large doing great. Guys that sell food that are not grocers, guys like Walmart, Target, doing great, right? Home improvement retailers surging, right? Things get bucketed. What I found very interesting about the last couple days is the dichotomy within segments. Nordstrom's and Macy's surge, Kohl's struggles, right? You would think that that's kind of the same type of thing, right? Williams-Sonoma does really well, and so does Dollar General, right? I think Williams-Sonoma is the kind of thing that attracts the, upper middle class or better type guy or woman, but also Dollar Tree and Dollar General do really great, right? So I'm not sure you could take a theme out of this, but in a minute we'll talk about what this does to our outlook for commercial real estate on the retail side.
I will say that I thought it was interesting that both Dollar General and Dollar Tree said that while their sales and their outlook looks great, shoppers are changing what they're buying. They're not buying the decor, the apparel, they're actually buying food. And that's a bigger part of their basket when they go into the dollar store. So
Right.
it's interesting that from a food perspective, people are being selective. And in some other areas, people are also being selective, but on the higher end where they have an event to go. And I got to tell you, it is wedding season, big time. And people who didn't get married for about 2 years, I think this year is the big wedding year.
Yeah, I guess so. We're going to talk about this in the office space about maturing office loans. This is like maturing millennial marriages piling up, right? Things that couldn't happen in COVID. But I'll go back to your comment, Lonnie, on Costco. I just thought about this a second ago. I think that was a big miss by the Costco guy. He just had to keep the price the same and start selling pigs in a blanket, right? It's just like every other guy does,
Smaller
right?
hot dog.
Scott's toilet paper, no longer 2 ply, it's 1 ply. You know that? Crazy, right? You get the Haagen-Dazs ice cream now, right? It used to be the size of your fist, right? Now it's the size of your thumb, right? It's just a terrible, terrible trend we have going on right now, right? This shrinking thing, and the box is the same for the Haagen-Dazs, right? So you're thinking, okay, I'm getting the same amount, and you go in there and you got to like go up to the elbow before you find an ice cream in the box, right? It's a terrible trend. But to your point, Martha, I think that this is one of the sad things that comes out of inflationary trends is on the economic spectrum, it's going to hurt the people at the low end most, and a bigger percentage of their basket of goods every month is going to go to food, and it's going to take away discretionary. It's going to take away trips to restaurants, and it may impact vacation travel. So the sooner we get back to something below 5% on the inflation side, the better.
On the subject of retail, the ICSC annual conference known as Recon had their meeting, and it was a solid comeback in Vegas this week. And our own team was there, headed by Lonnie. Lonnie, what was the vibe there?
Yeah, so it was good being in Vegas at ICSC 2022. So ICSC had kind of dipped its toes back in the water in December of 21 and had lukewarm response. So they were really kind of hoping for 2022, this annual conference, to be an upbeat or really a departure from that tepid response in 21. And I think they achieved it. So when we walked in this year, over 22,000 registrants in attendance, which is a little bit lower than their pre-pandemic high of about 30,000, but still a really strong showing. It was very encouraging. The floor was abuzz. There were a lot of people there. It was back to deal making, crazy outfits, people laughing. It was a really good time. It was good to see. If you haven't been to ICSC, it's an incredible conference. I mean, there literally is just rows and rows and rows of retailer and commercial real estate data and analytics companies, and anything related to CRE is available there. It's like a winter wonderland, but for nerdy real estate people. That's really exciting. And so it was good to see them back. As an attendee, though, I actually took advantage of us being there and had a chance to speak with Stephanie Cegielski, who's the VP of Research and PR for ICSC, and talked with her a little bit about the overall sentiment in the CRE landscape.
Things are good, especially for the open air folks. Obviously, they, the pandemic was rough on everybody, but a lot of the open air landlords, were grocery anchored, were big box. But even then, the mall segment is seeing kind of that resurgence of, in general, we're just seeing a lot of people ready to sign leases now. And, it's early, so it's hard to say, are those people from the Great Resignation that suddenly went and became entrepreneurs and are opening their own businesses? Is it, there is a lot of expansion going on within retailers. We have seen this year very few announced store closures and a lot of announced store openings. We've only seen one announced bankruptcy, so it's a strong year. The economics of inflation and Wall Street would seem to indicate something else, but it's interesting because it's in general the strange juxtaposition right now, and the industry is really benefiting from it.
And then I also asked her a couple of questions around how brick and mortar retailers are planning for the next challenges.
There had already been this significant shift to, the omni-channel world, and so a lot of retailers weren't quite there and found themselves, implementing a 5-year plan in a 6-month window, and it worked well for them, and it made a difference for some of those businesses because they were able to move to the online, curbside thing, and it allowed them to survive, which was beneficial. And so I think that's a significant positive. You also, the biggest challenge in probably the last year, supply chain aside, has been traffic patterns shifting time of day. So when it used to be I got off work at 6 and then I went to the grocery store. Now I have a break between calls at noon and can go to the grocery store. And so the retailers are starting to, have to deal with that a little bit differently, which is not a bad problem to have.
Right.
It's just a new problem. And really what we're seeing too is, for the most part, not totally, but a lot of the supply chain issues are starting to rectify themselves. We're probably a solid 12 months away from having, a good flow there. But really, it's this shift in consumer behavior in response to the inflation.
So it was really interesting hearing her response to those questions. I think she did a really good job of just kind of explaining how the industry's been impacted through COVID and how it's bounced back. And I think the conference was kind of a symbolic way of showing that the market participants that helped propel that industry were ready to come back. They've been making deals this entire time. The dynamic, the relationship, the networking portion has been a little bit different with Zoom, less face-to-face interaction, less large-scale conferences. But it was a really good site. It was really good to be there. And I'm hoping that this just kind of kicks us back into, what we would consider a normal ICSC type of conference and venue going forward. So a really great takeaway for Trepp, for myself personally. That was a really great couple of days in Las Vegas.
We'll have to devote a podcast in the future to what Lonnie would do if there was no commercial real estate industry, right? What would be his go-to profession if he didn't have this to get him out of bed every morning?
I would be a race car driver.
Yeah, or a sad, sappy poet. I would probably it's not great.
That would not have been a guess.
Yeah, I need the high energy interconnectedness of the CRE folks to keep me going. If not, you guys might be seeing me writing some sappy love poetry or something like that.
Wow. Okay.
Did you see Lonnie's wife, meeting with the front door tonight saying, "You are not becoming a poet, buddy."
I think my kids just ran out of the house. They're like, "What is this poetry talk?"
Oh my God. Well, we have a couple retail stories that we can run through, Manus.
So, we always try to look for themes in retail. For a while, our theme has been extend and pretend, CMBS purgatory for malls, things that are not getting done, right? Things are just languishing post-maturity, but pre-resolution, right? The mall or the shopping center or the big box is just not foreclosed upon, but delinquent. Right? Not REO, not sold, no resolution, and it just languishes. But we did see some movement on a couple of things this week, which we highlighted. These may not be the be all and end all of these stories. A lot of times these things are quite fluid. But we saw one story in which at Pennsylvania Outlet Mall, the workout strategy code that the special servicer populates each month with servicer data flipped from an expected foreclosure to a modification. This is the outlet shops at Gettysburg. This is a loan that had seen its collateral cut by more than 2/3, debt service coverage well below 1.0x, occupancy was 73%. So here you have a situation where, again, sometimes you see a strategy code go from foreclosure to modification. It seems like there's progress with the borrower about keeping the property, restructuring the loan term and so forth, and then it flips back to foreclosure. So this is perhaps not the final word, but it is an indication that maybe the mall owner here may change his mind and may fight for this thing. So we saw another one here. This was the Bayshore Mall in Eureka, California. A couple of years ago, the owner wanted to throw back the keys. May servicer data revealed that the loan has now flipped to current. right? So again, a situation where the property looked like it was headed towards first a foreclosure, probably a consensual one, cooperative one, and now 2 years after COVID, flipped back, and the tenant and the owner now wants to fight for this thing. So, what made this one so interesting for me is that the collateral is only 67% occupied, and the inline space is only 62% occupied. So, again, we're not talking about a Class A property here where the owner is saying, yeah, we were kind of stupid. We never should have thrown this back in the first place. These are the epitome of cuspy properties, and the owners at least are giving hints that they may want to hold on to this. Another one, I thought this was a terrific story here. In Lincoln, Nebraska, the largest mall in that city sold. Washington Prime Group, which I think either filed for bankruptcy or was on the cusp of bankruptcy a year ago, if I'm not mistaken, they were the acquirer here. And to reference old friend Darren King, he would call this an everyman mall, right? A Dillard's, a JCPenney. This is not your Apple, Nordstrom's, high-end jeweler type mall. This is an everyman mall, and here you go, seeing this sell for more than $50 million. So some decent stories out there, or at least some decent tea leaves, if you will, in the retail space.
Yeah, I'd like to see a little bit more on some of those, Manus. Like, we don't have all of the data behind those deals, but if you just look at them at face value, the Pennsylvania Outlet Mall was valued in 15 at 64 million, reduced all the way down to 18.4. Now they're trying to modify and stay in it. The California retail loan had a value at 69 million in 14, cut down to 29 million most recently. So it just goes to show, I mean, if I were looking at that objectively, probably not viable, given the new valuations, but it's good to see that they're fighting for them. There's probably more to the story that will come to light here in the next couple of months, hopefully, for each of them.
Well, longtime CMBS guys know that from time to time, what will happen with these things is the loan will get bifurcated. The A note will be reduced to about what the value of the collateral is now, or maybe a little bit ahead of that. The borrower will put in a little bit of equity, and a B piece will be introduced. That may be the ultimate outcome here. As you said, Lonnie, these properties are valued well below the outstanding amount of the note now. So there's a lot more to be told to the story, but it is of a piece. We talked about this last week, the Westfield Mall being taken over by somebody else, extending the loan 5 years and saying we can make a go of this. And so if there's a theme in the mall space right now, it's maybe not that these are going to be great outcomes, but there's signs of movement, right? A clogged artery now has a stent, it looks like, and things are starting to flow a little bit.
So let's turn to office. And this week I noticed there was a story that, Manus, you were quoted in. It was in the Real Deal, and it was regarding office maturities. It's some $7 billion worth of office debt is going to be maturing, according to our data. And the story written by Rich Bachman highlighted a specific property, but it was talking about what was going to be happening in the office market in New York City.
Yes, Rich and I go back a ways. He covers the CRE and CMBS markets quite well. And, what he's looking for is, we're at a place where people are trying to figure out what these offices should be valued at a time when you have a lot of loans maturing. And what you're seeing is really that $7 billion number is big, but it's made up of two parts. And CMBS traders and investors will know this. It may be a little bit, new information for those outside those markets, but there's two types of loans that make up that $7 billion. There is the guy or gal who took the 10-year loan in 2012 or the 5-year loan in 2017, and now it's maturing in 2022, right? Hard maturity, 5-year or 10-year note, and they are in a position where they will have to go out and refinance this thing. There will be a balloon payment due, and they will either have seen appreciation in their asset over time, and if so, they will be able to get a new higher loan balance in all likelihood and pay off that balloon amount, But if they are an owner of a property that has seen dwindling occupancy or falling rents, right, that may be more of a struggle. But that's one type of loan that will mature this year. The other type is what comes from these big single asset trophy loans, often which come with more complex terms. A loan that was written in 2018 might have had a 2021 maturity date, but the owner has 3 or 4 one-year extension options that allow them to push out the maturity, first to 2021 and then to 2022 and then to 2023. So for those borrowers that maybe had their first extension option in 2018 and they're out of extension options now, they're like the 10-year guy who has to refinance, right? They have to have takeout financing and get a new loan. But of that $7 billion, there's a fair amount of owners that still have extension options that will likely exercise those options and just extend the loan as they are legally entitled to for another 12 months or 24 months or 36 months, as the case may be.
Yeah, those extensions though can get a little bit pricey. I mean, I think generally there's extension option fees involved, usually, half a basis point or 50 basis points or 1% of the loan balance or something like that for those extensions to exercise them. So to your point, it's a viable option in some scenarios, but for a lot of folks, that can get fairly pricey very quickly. It'll be interesting. We've been seeing in practice these cash out refinance for the last 10 plus years where, as you described, man, if somebody takes out a loan, the value increases, it comes time for renewal, they're able to get a new larger loan in excess of what the current loan is, actually take out an equity distribution and refinance the property. Do you think for some of these B and C office properties where they've been hovering at 60 or 70% occupancy, we may actually start seeing a shift there where it's a cash in refinance where in order, like we've seen it in the mall space where the owners have to bring equity to the table in order to refinance these properties?
I think that's certainly a possibility. I think you have a couple of headwinds there, right? Headwind one, you identified as falling occupancy, falling revenue, maybe cuspy debt service coverage ratio, but in all likelihood, they're refinancing into something that's a higher rate than they had currently. We started to do some preliminary analysis. I'll front run this a little bit at CREFC, which takes place in another 2 weeks, 3 weeks, something like that in New York. It's the annual CMBS commercial real estate trade event. There's 2 of them. There's one in Miami in January, one in New York in June, well attended by lenders and money managers and issuers and so forth. But we've been working on a piece which talks about, the impact on debt service coverage ratio to higher interest rates. And so what we looked at, and I don't want to give away the entire headline because it'll make its way into a magazine that our sister company, Commercial Real Estate Direct, will release at the conference, is how much in DSCR does refinancing where a firm is today, an owner is today, into a 6% rate, and what that's going to cost them in debt service coverage ratio on average is about 40 ticks, right? So a 2.6 DSCR will become a 2.2 DSCR on average, going from what rate they have today to a 6. Now, there's an awful lot of noise in there, right? Some guys have rates of 3, some guys have rates of 5.5, right? Depending on where you are today, the pain is very different. And all property types will have different lending rates when they have to refinance, right? Multifamily will be very different than hotel. But that being said, right, if you think I have something cuspy today at a 1.40x retail property, with a 85% occupancy, you may be refinancing into a term sheet that says your DSCR is 1.2. And to your point, that then probably becomes a cash in. And the same thing would be true of the office.
We had a number of stories in the office space, and I got to say, they don't look like good news.
Well, last week we were so full of good stories, both in the retail space and in the office space. This week, more of a mixed bag on retail and in office. I would say we used a term 5 years ago for retail that no one event was catastrophic for retailers, but what they were facing was death by 1,000 cuts. And what that meant was, at all these shopping malls, they might have 75 inline stores. So a shoe store, a jewelry store, a hat company, a couple of restaurants, some small apparel places, and the apparel place would go Chapter 11, right? Liquidate, or Chapter 7, liquidate. And so now they're going from 75 to 74 paying tenants because that apparel entity is now gone. And losing one tenant is never going to break the back of a mall owner when then the next week the jeweler announces they're closing 300 stores. And then the week after that, the hat company is out of business. And then Sports Authority or Toys R Us, right? So there was a drip, drip, drip of death by 1,000 cuts for these retailers. And now we're getting a hint of this in the office space, right? Between layoffs and downsizings, it's starting to feel a little bit like the early days of the retail carnage. And I don't think it turns out the same. I don't think we see this mass number of office defaults, but I think this is going to become more than just ankle biting for office landlords over time. And I'll run through some of these stories quickly. In New York, this story from Jen Spillane on our research team, Burberry downsizing their corporate offices, going from about 70,000 square feet to 30,000 square feet. Also in New York, this is in White Plains, a New York City suburb, Sabra Dipping Company. I couldn't tell you what they make. I'm not sure if it's salsas or mustards or stuff for your buffalo wings, but they up in Westchester downsizing from 36,000 square feet to 6,000 square feet, if I remember correctly. In New York, another one here, HSBC, sole tenant in a commercial condo in kind of that Union Square. They will be vacating when their lease ends later this year. In New Orleans, at 1615 Poydras, I hope I pronounced that correctly. Never been to New Orleans. FM Services, second largest tenant at that property, terminating their lease. So there's a lot of this going on. Tulsa, Oklahoma, Laredo Petroleum, same thing, looking to terminate their lease. It's a 300,000 square foot office in Tulsa, Oklahoma. So that's one part of the puzzle, right? That's part of the ankle biting. The other part is, the layoffs that are coming where they haven't reduced the size yet, right? So this week, Lyft, budget cuts, tapping the brakes on hiring. Uber had done that the previous week. Among busted IPOs or formerly high-flying unicorns, Getter, right, which is a delivery service, layoffs. PayPal, Latch is one of those companies that allows you to unlock your door remotely if you have, a home to rent, something like that. They claim that they are in dire financial condition. They're almost out of cash. TaskRabbit in San Francisco closing its offices permanently. So no one of these stories will keep a office owner up at night. 10 of these things, if you're with a tech-centric creative office, starts to become more than annoying.
Yeah, if you look at just the headlines on these, as you went through the stories, man, it's downsizing, vacate, terminate, vacate. It's pretty ominous of what we're seeing in real time. And to your point, none of these on their face is enough to shift the market. And but a couple of takeaways. I mean, Manhattan has available sublease space at near record of 20 million square foot, according to CBRE. So each week we've talked about downsizes. We've talked about tenants relocating or moving to cheaper locations, maybe more tax-friendly locations. We're starting to see that play out. These tech companies with these crazy names, it's almost like they should get assessed a fine for these names. Getter, I don't know. I don't know what the success metric is on that, but we should create some sort of an index. Like the crazier the name, the less likely they are that they're actually going to be successful. Maybe I'm old school, but it's a little bit crazy when you see some of these companies raise a ton of money. Nobody even knows what they do. If you look at the name, it doesn't make any sense at all.
We'll have to devote a podcast to what poet Lonnie Henry would name a startup company if you were to both become a poet and to not have a commercial real estate world to keep him occupied? And what would his go-to catchy name be if he was trying to raise money? And what would his product be?
Well, I might use the poetry and turn it into a rap song, as you guys know. So, so we'll have to talk about the business name. So, but yeah, that could be that may be like an after hours acoustic version of the podcast.
Well, we'll give you a week, Lonnie. We'll come back to you next week. You have the entire Memorial Day weekend to work with your kids and your wife about first telling them you're going to become a poet. And after you explain that, you say, like, now I'm going to do a startup and here's what I'm going to call it. You can come back to us next week. But, to complete this thought, and I guess I'm being repetitive here, because I've said it now several weeks in a row, you talk about the wealth effect. And when valuations are high, rich companies spend money feverishly on new office space, amenities, perks, new hiring, increasing staff, retaining staff, stock options, and everything else. And when valuations fall, those spigots are turned off, right? And that is a risk to the commercial real estate market, that all of these high flyers, start to tighten their belts a little bit. And on the other end of the economic spectrum, which is the startups, when everybody's flush, people are throwing money at the getters and the latches and the task rabbits and so forth, and Lonnie's, soon to be named company. But when things, get rockier, the private equity companies are less willing to go through that seed money and fund Series B and Series C and so forth. And that is what leads to guys running out of cash and rejecting leases and so forth. And right now, on the Thursday before Memorial Day, sentiment feels better, right? Does that continue next week? Who knows?
And we had a trading alert on a New York office loan.
Yeah, this goes back to Lonnie's point about guys with maturing loans and are they going to be able to take out refinancing? This is a property in Midtown Manhattan. It's really you throw a baseball from third base to first base. That's about the distance it is from Grand Central Terminal, 285 Madison Avenue. That loan was sent to special servicing. The borrower has requested a maturity extension. The fixed rate loan matures at the end of this year. It is about a 500,000 square foot office, right in the middle of Grand Central. DSCR is cuspy, 1.12x. Occupancy is 96%. It has $235 million in A note encumbering the property. There's also a $35 million B note. So in this case, it looks like the owners are saying this is going to be a struggle to cash out without us putting cash into this or refinance flat out of this particular asset. They're looking to get ahead of this. And if we're reading between the lines, they're trying to get the special servicer's attention, trying to see if they can get a 1 year or 2 year extension, which buys them more time to either improve that DSCR number and ultimately get the takeout financing at something that doesn't require cash in.
So you mentioned, Manis, that was a SASB loan, and you've talked about that a couple times today. And our own analyst, Jack LaForge, actually did some work looking at single asset, single borrower transactions. And they've, not surprisingly, because we've talked about this before, since 21, they've outpaced the other transaction types. And he took a look at some of the details behind those trends.
Yeah, so 2021 was a watershed year for the SASB loans. So as you mentioned, Martha, 81 billion in SASB loan issuance in 2021, which was more than the conduit loan issuance for the first time. It was an increase of about 200%. 2022 year-to-date statistics indicate SASB issuance is primed to cement its position as a leading CMBS transaction type again. So these have been predominantly dominated by lodging and office properties over the years. Both sectors have some of the most highly valued properties in CRE, which is really kind of the hallmark for single asset, single borrower framework. In 21, though, that shifted. Industrial really took up a lot of slack there. So the industrial sector accounted for about 16.9 billion in issuance. Well, excuse me, office was at 16.9 and industrial was at 16.8 billion. So that was kind of a new entrant into the SASB space, which had previously been dominated by office and lodging sector. In 2022, See another shift toward multi-use in the lead for year to date at about $8 billion in issuance for 22. And then year to date, the percentage of loans that are floating rate have dropped from about 85% in 21 to 68% in 22, which I think is indicative of just the market that we're in as it pertains to interest rates and them increasing. So, very interesting to see the single asset, single borrower. I don't think I would say I'm surprised by any of this. I mean, times of market volatility, Manis just talked about this trading alert for the office in Madison Avenue. Your cream of the crop, cream rises to the top. The large scale hotels and office properties have historically been able to secure financing in markets, even when the economy is more challenging for other lesser properties. But just to see the overall issuance volume be as large as it is, that is something that we haven't seen before. So it'll be interesting to see if it continues on that pace. I think, as Manis has mentioned, kind of the wealth effect and the winners and losers. By definition, a lot of these are trophy assets and will probably continue to outperform in the market. So I wouldn't be surprised to see issuance continue on, maybe not this level of pace, but maybe more than what we've seen in the past on a relative basis.
Yeah, and thank you for defining that, Lonnie. We tend to use that SASB term very loosely without defining it, and you defined it as single asset, single borrower there. So there's really two types of things there, right? There is the single asset, which is you're securitizing one building, which is, like Lonnie said, a big office, a big 5-star hotel, a big resort, something like that. Or it is a single borrower who's securitizing maybe 150 industrial properties or 150 extended stay hotels or something like that. So those are the two things that get there. But, the reason this market exists is that if you go out and buy a filet mignon, right, you eat the filet mignon by itself because it's a great piece of meat. You don't chop it up and put it in a soup because you want to savor the flavor of the filet mignon, right? You don't want to dilute it with all this other stuff in a soup, right? If you're going to make a soup, you put in the dark meat chicken, right? Or something like that, right? What you're seeing here, why this market exists is because these are trophy assets and they're so desirable and they're so strong that these owners, these borrowers can get, prime rib or filet mignon like pricing when they're by themselves. If you take that asset and you throw it into a collateral pool that includes 99 other loans, which are the rest of the soup, they are not getting the same execution. They're getting degraded, just like filet mignon would in a soup. A big trophy asset would get degraded in a larger pool and would not get the same financing terms, low rate, flexibility, everything that comes with it, that they would get standing alone, if you will. So not to mention the fact that the loan would be so dominant in a conduit pool that it would break the rating agency's models, right? You'd have to cut it up into multiple pieces, which we do see happen sometimes.
Yeah, the size of these loans are really one of the challenges too, because most of them are really, really large. And to your point, Manis, I think Blackstone had a couple of the industrial single asset, single borrower deals where, they have industrial assets across the U.S., but because it's Blackstone, they're able to package them up as a SASB. Great Wolf Lodge would be another example of like a hotel operator that has 10 or 12 assets across the U.S. that are trophy that they put into a single asset, single borrower deal. And then like a single asset would be an example of that would be like the Houston Galleria Mall down in Houston, Texas would be, a single asset, single borrower deal where it actually is just one property, but that one property has a loan balance of a couple $2 billion. So, those would be some real life examples of SASB deals that we're tracking in our platform now where, you could have every scenario you just outlined, in real time.
All right. Shout outs. Black Eagle Real Estate on Twitter. Happy to report the Mills Mall in Nashville was busy on Saturday afternoon. Busy, but not packed. So positive sign. Jared L. from FSU, one of our future leaders, which by the way, we had an amazing number of future leaders this year apply to win the award and a very impressive class. He said he's been listening to the podcast. You ready for this, Manis? Consistently for the past 30 weeks. And it's the only podcast I have notifications turned on for. So, 30 weeks, I kind of feel like, when they play rock music endlessly, when they're trying to break through a hostage situation or something like that, kind of thinking this poor kid has been listening to us for 30 weeks.
Right. It's a nonviolent form of waterboarding, right? That's really what we're kind of talking about there.
Let him
Someday
out.
I want you guys to promote me, like I see all these things, the top 40 under 40. Next time something comes out, when they have, the top 55 between 55 and 60 east of the Mississippi and north of the Mason-Dixon line, I want you guys to go all out for me to make sure that, I'm somewhere, on that top 55 list.
We'll write you a reference. You're shooing. And Sam Shannon on LinkedIn shared pictures of the client event we had last week. Joe D shared the Rich Bachman article in The Real Deal on office maturities. Dan M, who's been a friend of ours for some time, sent us a contact that he thinks would make a good podcast guest. So we will check him out. And as you had mentioned, Manus, it's going to be a long weekend. And even though gas prices are about $2 higher than last year for a gallon of gas, a lot of people are still going to take a road trip higher than last year. And I myself am taking a road trip and going to a wedding with my Nordstrom dress. What are you guys doing?
Your Williams Sonoma wedding gift. That's
yes,
right.
I am.
I
check all the boxes.
You'll be part of the reason that Williams Sonoma next quarter again outpaces expectations. Before I get to that, I will go through a couple more shout outs. Donut Shorts gave me the Lyft layoff heads up. All those earnings stuff, a lot of the stuff that we referred to before comes from one-time guest of ours, Lauren Thomas, who really covers that terrifically for CNBC. She is really my go-to person when I'm looking for quick hits on pre-market or post-market, after the bell earnings announcement. She does a great job. And then lastly, because we're in Memorial Day, a huge shout out to everybody in the military, current and former, that keep this country safe. I was out with several men and women last night from Trepp. We sat outside in Midtown Manhattan, a bar called Elgin, which was quite enjoyable. But it's Fleet Week in New York, and every time a pack of 5 or 6 guys walked by just checking out Manhattan, their uniforms, they got many ovations from the people that were eating and drinking outside. So I really love that. Freedom isn't free, and we should never forget that.
Are you having a memorial hot dog?
Well, I don't know. If I go to Costco, that seems like out of my price range. I might get some pigs in a blanket. I don't know. I think the Mets are back in town. Right now, I know it's a tough time for a lot of people out there with inflation and expensive gas, expensive food, but the Mets are in first place. The Rangers have tied their series in the playoffs, and I woke up again this morning. So how good is that? Happy Memorial Day weekend, everybody.
Yeah, it sounds like I have some work to do on naming a startup and coming up with some poetic lyrics or something for us to read off on the next week's episode.
Rhyme it with Sabra, which makes hummus, by the way.
I was gonna say, when Manus said he wasn't sure what they made, it's hummus, but
hummus and guacamole.
I've never had the hummus, never gonna have the hummus. So yeah.
With that, we'll close. Thanks to our producer, Haley Keene, who's got her work cut out for her tonight. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Enjoy your weekend, guys. Thanks for listening and stay well.
All right.